To everybody. Today we shall discuss about Indian financial system. What is Indian financial system? What are the features of Indian financial system? What are the objectives of studying financial system? What are the types of meaning of financial services, types of financial services, etc. is covered under module 1. So, first of all, meaning. It refers to a set of activities which facilitates transfer of resources from savers to borrowers. It refers to a set of activities which facilitates transfer of resources from savers to borrowers. So, a set of activities which facilitates transfer of resources from savers to borrowers. May I ask you one question? Here resources means what? Anybody else in the class? Yes. Resources means money. As under financial system, it refers to money or cash flow from one person to another. So, a person who saves money which is transferred to some other needy persons based on some ground, based on contract. So, the savers or the investors provides some services to those persons who are in need of finance. Next, it's an institutional framework existing in a company that provides a regular, smooth, efficient and cost-effective linkage between depositors and investors. It's an institutional framework existing in a company. So, normally the company need finance. So, provides a company need finance which is collected by the company from the public in the form of deposits, shares, in loans and advances, etc. So, institutional framework existing in a company that provides a regular, smooth, efficient and cost-effective linkage between depositors and investors. Can you follow? So, your question is, sir, whether financial system is applicable to company only? Yes, normally the company need huge finance for meeting its goals and objectives. It collects the funds from public. So, a system is there, some services is rendered by one person to another. Then, definition. It is defined as a set of institutions. Please note, set of institutions, not a single person. Set of institution here stands for state government, central government, then other corporations, then financial institutions, bankers, then other person who are ready to provide finance, and market which fosters savings and channelize their most efficient use. So, a set of institution and instruments. So, the three words. Institution work is there. There are some instruments which are used for collecting funds, instruments, financial instruments, instruments through which one will collect the fund from the public. You know, that is equity shares, yes. Preference shares, yes. Debt, yes. Debenture, yes. Bond, yes. Loans and advances, yes. Treasury bills, yes. Commercial paper, yes. Commercial papers, yes. Certificate of deposit, yes. These are known as financial instruments. Instruments which are used for raising finance. Market. Market, you know that it is a money market, yes. Capital market, yes. Foreign exchange market. Okay, so three words are used under finance system. The first one is known as institutions, second one is called instruments, third one is known as markets. So the three elements which play an important role under financial system. Okay, the next one, concept of financial system. Concept of financial systems. What are the points which are included under financial system? Please recall from your memory, there are 4. It comprises financial institutions. Yes. Financial markets. Yes. Financial instruments. Yes. Financial services. So, institutions, instruments, markets, and services. Financial instruments, financial market, financial institutions, and financial services are the concept of financial system. Anybody have any doubt? Last bench. You have any doubt? No. Shall I continue? Yes, thank you. Meaning of financial services. Financial services include all those specialized services. Financial services are known as specialized services provided for where we apply borrowing and funding. Yes, lending and investment. Can you follow? Yes. Buying and selling of securities, making and enabling payments and settlements, payments and settlement of debt. Next, merging risk exposure in financial market. So, 5 points, please note it. Financial services are some specialized services provided for borrowing and funding, lending and investment, buying and selling of securities, making and enabling payments and settlements, merging risk exposure in financial market. So, one word, what is the risk? What is the risk? Anybody in the class? No. You study risk and return under financial management paper, second year. Yes. Risk is loss expected by a person under uncertainty. There is uncertainty risk. Risk which is may or may not. Uncertainty result. Suppose you are doing a work, then you can't predict whether it tend to be success or failure. Suppose if it tend to be success, whatever will happen, inflows of money. If it tend to be failure, outflow of money, no one can predict. No one can predict. It depends upon number of internal as well as external factors. So merging risk may be of 2 types, systematic and unsystematic risk. You will study later. Okay, next one, definition of services. Activities, define activities, benefits and satisfaction connected with sale of money that offer to users and customers financial related values. So services which are connected with finance matter. Financial services. Services means one person do the work for another which are of intangible in nature. One is service provider and the is customer or beneficiary. Okay, next, nature of financial services. Intangible nature. What is intangible? Invisible in character or not physical in nature. So first point, intangible. Second one, direct sale. Third one, dynamic in nature. Then customer, it is based on customer orientation, focused on customer satisfaction, wide range of products. Under financial services, there are a number of products like equity, debt, bond, etc. Geographical dispersion. More funds are needed if you start a business in urban area or city level, and less amount is required for start the same business under rural area. It is called geographical dispersion. Labor quality. What is the quality of labor? If the quality of labor is well and good, then you spend less amount for it because no training is necessary. Training cost can be reduced. If it is inferior in quality, you have to provide more training to the labor, which will increase or which will shoot up your cost. So, nature of financial services, please note it. Intangible in nature, direct sale, dynamism, yes, dynamism, customer orientation, yes, wide range of products, geographical dispersion, and labor quality. So, from examination point of view, question may be asked, what are financial services? So, while if the question carries 1 mark, please note the meaning or definition. If it carries part B question 3 marks, please add nature of financial services part also. Next, functions of financial services. We can divide the functions of services into 5 points. Mobilization of funds. Mobilization means collecting of scattered resources. Effective employment of funds. Effective utilization, employment of funds means effective utilization of funds in a proper manner. That means you invest the amount, then you expect more return under less risk. So, less risk and more return while investing your fund. This is called effective employment. Employment means utilization of funds in such a way that where you can earn more profit at the same time under less risk. Provision need-based services. What are the necessary services? What are the unnecessary services? What are the provision needed for doing services? Provision of regulated services. Service should be properly controlled. It should be controlled by the Act. It should be controlled by the rules and regulations. It should be done by a person. It should be clear in nature. If any person violates service provisions, then put control over it. Next, enhancement of economic development. So, the main object of financial services is to enhance of economic development. So, 5 points. This because maybe asked under part B question, what are the functions of financial services? Put your answer under 5 points. Can you give any 5? Yes. Mobilization of saving funds, effective employment of funds, provisions of need-based services, provision of regulated services, enhancement of economic development. Over. Then, special features of financial services, intangible nature, we already studied, inseparable from the provider. There is no separation between inseparable, it cannot be separate. So, service provider and the consumer are the two eyes through which one will look what financial services. Then customer oriented, dynamic in nature, creativity of the customers. Creativity of the customers. What is then creativity of customers? What you can provide service to customers which will satisfy their needs through which they can achieve their goals and objectives. Types of financial services. Essay question. Please note part C question. What are financial services? What are the different types of financial services? Leasing, factoring, bill discounting, securitization, venture capital, credit rating, mutual fund, credit card, and merchant banking. So, there are 9 points. These points are studied by you under separate chapter under module 2, 3, 4, 5. 5 modules The remaining 4 modules covers these types of finance services under separate chapter: leasing, factoring, bill discounting, securitization, venture capital, credit rating, mutual fund, credit card, merchant banking. Next, funded based services. Funded based services means you provide funds, huge amount provided by you for long term purposes, more than 3 to 5 years. You hands over the cash to a person for a period of 3 to 5 years. It's called funded based services. Out of 9, please note lease financing. Lease financing means you hands over the fund to a person in the form of, and which is used for purchasing an asset that can be used for your business. Okay, hire purchases, bill discounting, consumer credit, venture capital, house finance. These 6 terms are studied by us later. Fee-based services. Fee means you collect fees from the person. Issue management services. While issuing securities or debts to the public, you have to incur some expenses. So, the service provider acts as an intermediary for doing this function. So, he charge some amount for it. It is called fee-based services. Portfolio management services. Portfolio management means number of alternative investments in front of you. You have to select the investment which will help you to attain your goals and objectives. So, he is playing a financial analyst or advisor to deposit your fund in different areas. It's called portfolio management. The main principles of portfolio management is 5 points. That is what? Safety, yes. Security, liquidity. Then safety, security, liquidity, risk and return. Next, advisory management services. That is consultancy services. You possess enough funds in your hand. In which area you want to invest your funds under less risk, at the same time more profit or return. Capital restructuring services. Restructuring means changing or altering the equity capital and debt based on debt equity ratio. So the question may be type services, fund-based services and fee-based services. There are more than 10 points in this connection. Next one. Next one here. Merchant banking. So, merchant banking means a merchant banking is a specialized financial intermediary who helps to mobilize the transfer of capital from those who possess it to those who need it, etc. It is a specialized financial intermediary system. They will help the company or organization to do business. They undertake any activity in capital issues and play different roles like lead managers, co-managers, underwriters, consultant, portfolio management. So merchant banking, banker plays different roles. He's an advisor, he's a consultant, he's an underwriter, then he's a critic, he's a lead manager, etc. It includes a wide range of activities such as management of capital structure. What do you mean with the term capital structure? Any idea? Anyone in the class? Structure, capital structure. No idea? Yes. Capital structure means nothing but the proportion of own fund and borrowed fund, under net worth. What is the proportion of own fund? Own fund means owned by the business. What is the proportion of borrowed fund? If you add it, you will get 100%, that is net wealth. So, it includes wide range of activities management issues, portfolio management, corporate counseling, project counseling, underwriting and loan syndication. So, what are the functions of merchant banking? It includes several functions like management of capital issues, first point, portfolio management, yes, capital structuring, yes, counseling, yes, project management, yes. So, if the question is asked for short notes, how will you write? Merchant banking. Merchant banking means it is a specialized financial intermediaries who play a role of an agent for doing some business. They play the role of consultant, advisor, critical analyst, lead manager, etc. It includes some of the activities like framing of capital structure, portfolio management, yes, portfolio management, corporate counseling, yes, then project counseling, underwriting and syndication, loan syndication. Second is lease financing. What is lease financing? Suppose you are the person, your company is engaged in manufacturing operation. For doing such operation, you need some assets, fixed assets like plant, machinery, etc. At present, you are not able to purchase a machine. For purchasing it, you have to spend more. So at that time, a company which will helps you to procure or acquire this asset under two bases, operating lease and financial lease. So they will help you to do the manufacturing activities. Leasing. Leasing means you are not the owner, you are the possessor of the asset only. For one person transfers the possession of the asset to you and asked you to use it. You use it. Some benefit is derived by you. That benefit is hands over by you in the form of rent or royalty. It's called lease finance. So the leasing companies are there. They play an important role for providing fixed assets. You have to spend more amount for that. Venture capital. Venture capital means it is a specialized financial services for long-term purposes. For doing any kind of business, venture means business. Doing any kind of business, you need finance. You file all documents for raising finance from bank or institutions. So the institutions which will provide you initial finance for promoting the business, but it will provide you stage by stage finance. That is, first one promotion stage, developing stage, reaching stage, etc. 3 stages. So under each stage you will get some financial help from the institution. Okay, so venture seed capital. Seed capital means initial capital contributed by a financial intermediary for protecting you or help you to do manufacturing business. Next one, credit rating. Credit rating means it's the rating. It's a rating of the company. The rating is based on past performance of the company, liquidity of the company. There are 5: liquidity, profit, risk, etc. Based on this, the company is categorized into more than 8. Credit rating is done by normally there are number of agencies, private companies, it is called ICRA, CRISIL, etc. They are the companies which will ranking the companies. If the company is 100% good, triple A, double A, triple B, double B, B and B, C and D. If the company falls in D category, it will not get any financial help from the institutions like state government, central government, financial corporations or financial institutions, etc. So the categorization helps you to identify the company which will earn more profit. So the credit rating is a tool in the hands of the analyst for doing portfolio management activities. Hire purchase, a system of transfer of assets from one person to another. The person who transferred is known as hire purchaser, another person is known as vendor. The vendor transfers the asset to a person and asks him to use it. The person uses it and share of profit is given above rent or royalty. Here transfer of temporary ownership from one person to another is known as hire purchase. Bill discounting. Bill discounting is nothing but the short-term advances given by the financial institutions to the company. Bills of exchange is a negotiable instrument. Okay, it's a short-term credit instrument. Suppose you are in need of finance, you executed instrument on the basis of that which you can raise money from the public. You simply hands over the bill to the bank based on security and ask you to pay the amount in advance. So, discounting means nothing but encashment of the bill amount prior to its maturity date. Factoring services. Factoring services means that is a factor. Factor means an intermediary or agent in the market. Suppose you are doing business. You follow cash and credit principles of while selling the goods. Trade sales take place. Number of customers are there. Okay, then debt is outstanding. You are unable to collect the debt from the public immediately. So you approach an agent in the market. He play the role of an agent of you and collect the money from the debtor on behalf of you. Okay, you pay commission to them. It is known as factoring commission. So factoring means an agreement between a third party and the company for what purpose? To collect the time-bound debts from others. A commission is handed to them. It is called factoring commission. The agent is known as factoring. The agent is also known as factor agent. Next one, insurance services. To protect the loss from unexpected accidents, that is events which are uncertain, accidents, fire, earthquake, flood, war, etc. Sometimes you can't do operations. So what will happen? Your business is suspended for some time. That will incur loss. The loss is compensated by a financial institution called insurance company. Then the insurer person, the company is known as insurer, the company is known as insured, and you, the company is known as insured, and the person who insured is known as insurer, and the amount is paid by him is known as premium, and the document is known as policy. So these are the main functions of financial services. Next one, money market. There are three types of market: money market and capital market and foreign exchange market. Under money market, it facilitates RBI conduct of monetary policy. It deals with short-term policy, short-term monetary assets. Money market instruments, call money marketing, yes. Repos, repurchasing rate. Trustee bills, yes. Certificate of deposit, yes. Commercial paper, yes. Interbanking participation certificate, yes. Interest rate swap, yes. Bill rediscounting. These are the instruments which are used for short-term money market. Long-term money market, it is meant for long-term period. Here it deals with long-term funds for corporates and central government. It deals with debt market and equity market and derivative market. Next one, foreign exchange market. It is a market for foreign. It is a market foreign currency market. It takes place in case of international trade, exports and imports. You want to you want to import the commodity from foreign country, you have to pay the amount to them in the form of host currency. At the same time, you want to export it, you will collect the amount in a foreign currency. So foreign exchange rate means a rate of transaction takes place between host country and home country. In the foreign exchange market, central government, state government, central government institutions, commercial banks and merchant banks play an important role. Features of money market, financial market, operational efficiency, information efficiency, valuation efficiency, hedging efficiency. So, financial market include efficiency, operation level, yes, good, information level, yes, valuation level, yes, hedging efficiency. Factors affecting financial services: gross domestic product, this is called GDP, rate of savings, yes, inflation and deflation, yes, business cycles, yes, balance of payments. 5 factors, please recall 5 factors, yes. First factor, last bench, second boy, yes, GDP, balance of payments, yes, business cycle, yes, rate of savings, yes. One more, he missed 1 point. Anybody in the class? Anybody? There are number of points, 5. Gross domestic product, yes. Balance of payments, business cycle, inflation, deflation, rate of savings. Yes, exactly. You miss it. Rate of savings. Next one. Financial instruments are the instruments which are used for raising of funds from the public by a company as per SEBI, Security Exchange Board of Act. Can you follow? Instruments, yes, which can be used for, yes, rising finance, yes, from the public. Can you follow? Any doubt? Shall we continue? Yes. First of all, equity shares. If the question is asked to you, you simply say that equity shares are nominal shares. Good. Equity shares are issued by the company for raising long-term finance. Yes. The person who subscribes the equity share is known as equity shareholder. Yes. They are the owners of the business. Yes. They only equity shares holders can turn to be a director of the company. Yes. They will get a dividend called equity dividend of discharging the amount to preferential shareholders. Yes. Their amount is repaid only at the time of winding up. Yes. So you quote all these points under your graduate level, not under PG level. Am I correct? Yes. But under financial system, slight change. Equity shares means, how will you define? It is certificate representing a company's ownership. It is certificate representing company's ownership. And equity shareholder is a part of the owner of the company with certain rights and responsibilities. Yes, that is all the points, 7 or 8 points quoted by you in a single nutshell, simple point. It is certificate, yes. Representing company's ownership, yes. The equity shareholder is the actual owner of the business, yes, with certain rights and liabilities. The rights and liabilities are known as equity shareholders' rights and liabilities for conducting the business. If they violate any provisions in the Companies Act, then proper action can be taken by the court of law. May I ask you some questions? Third bench, first girl, please stand up. Listen here. What do you mean by the term the Companies Act? In which year it was introduced? In which year it was amended? Yes. Whether you are BCom or BBA? BBA. Whether you study company law under BBA or BCom? BBA study company law. You are a commerce, you are a plus 2 level, your subject is commerce. Am I correct? Yes. Tell me, which act control the company affairs? Yes, the Companies Act of 1956. Yes, 1956. Okay. On the basis of membership, how the company is classified? Yes, your answer is correct. Private company and a public company. Yes. What's a private company? If the answer is like this, a private company is a company of a private person. No, this is not the answer. What's a public company? A public company means it is the company formed by the public. No, your answer is 100% deviated from the original point. If the question is asked from the examination point of view, please write a private company is not a public company. What is a public company? Public company is not a private company. Okay, but there are 3 exceptions there. Yes, number of membership, members, issuing of prospectus, one more, transfer of shares. In the case of private company, all these were restricted. So, if a company's activities are restricted in connection with number of members, yes, transfer of shares, yes, issuing prospectus, it is called a private company. Automatically, if the restriction is deleted or released, that company is known as a public company. So, equity shares means it is a certificate issued by the company under its common sale. It shows the ownership for the actual owners of the business and discloses the rights and liabilities as per the Companies Act 1956. May I ask you one question? In which year it was amended? Which year it was amended? Interview question. Which year? Clue is you want to get clue? Yes. Unlucky number. Yes. 13. So it was amended in the year 2013. 2013. The Companies Act 1956 was amended. At present, we follow the Companies Act 1956 amended, Companies Act 1956 amended, Companies Act 2013. So, equity shares are 2 types. Mainly, Voting right shares and non-voting right shares. Voting rights. That is, if a resolution is passed in the meeting, equity shares are asked to cast their votes either in favor of the resolution or against the resolution in the board meeting. So, or general body meeting. If they cast their votes in favor of the meeting, the resolution should be passed, otherwise not. A resolution may be of two types: ordinary resolution and special resolution. If more than 50% accept the resolution, it is called odd resolution. Sometimes it needs more than 75% of the person who attend the meeting. It is known as special resolution. So, voting rights of shares stand for is a right given by the company to equity shareholders to cast their votes in a general body or a board meeting. They have the power. No one can ask any question or raise question against it. Next, non-voting right shares. Non-voting right shares means they have no right. So, two types of shares: voting right shares and non-voting right shares. Preference shares. Priority for getting dividend earlier than equity shares. Priority for getting dividend. Priority, actually they are not shareholders, but they can play the role of shareholder to a certain extent only. They can attend the meeting, casting their votes, getting dividend, but they have some responsibilities only, not likely to equity shareholders. That means they play dual role. On one side, they are the owners. They can participate in the meeting. They can claim dividends. Other side, they are the creditors of the company because they are not the actual owners. They are invited only to some meetings, not all the meetings, and ask them to cast their votes. So, preference shares are known as hybrid shares. Interview question: why preference shares are hybrid shares? Because the answer is like this: neither equity nor debenture debt. It possesses the characteristic equity as well as debt. So, it is called hybrid. Next, cumulative convertible preference shares. It has all the possible attributes of convertible debentures by providing flexibility and option to investors. Conversion. Convertible debentures mean debentures which can be converted into shares. So, cumulative convertible shares means either they can convert it into debentures or they can have the right to convert them into equity shares. So, convertible, changing their rights, changing their position, changing their designation. So, it is called cumulative convertible preference shares. Next, debentures. Debentures means a debt security issued by the company under its common seal. The person who subscribes it is known as creditors of the company. He will get the interest for his investments. Whether the company earns profit or not, they are not bothered. So, it is duty of the company to discharge interest to debenture holders. It is a debt to the company. The company should repay the amount before a time is fixed, either for long time or short time. It should be redeemed before the period or after the period with interest. A debt security is issued by a company acknowledging the obligation to repay the principal with interest at the qualified rate as the debenture. So, every debenture holder is entitled to get the principal amount plus interest when debentures were redeemed. Redeem means, don't use repaid. Under Companies Act, it is called repay. Same meaning. It is synonymous to repayment, redeemed. Next, convertible debentures. Then when the company is ready for redemption, either they have two options. Either they can collect the money from the public directly, or they can have the right to convert them into equity shares or preference shares. So if they want to be a director of the company, they can have the right to convert them into equity shares. Okay. Next, call money non-convertible deposits. These are non-convertible debentures on which interest is calculated as per the call money rates. That is non-convertible. Convertible means it can be converted into equity shares or preference shares. So debentures which cannot be converted, which can't be changed, which can't be the designation cannot be changed. They are always creditors of the company. It is a non-convertible debenture. Simple word NCD. Have you heard it NCD? If the non-convertible debentures mean NCD stands for non-convertible debentures. Bond. Normally, bond is a promissory note that is issued by a borrower for the repayment of the principal amount to the interest lender. Bond is just like a promissory note. Promissory note means that is it's a type of bill of exchange issued by the company, issued by a person. It is considered as a negotiable instrument. The company borrows the amount from the public, then hands over, then execute a document in favor of the lender. It is called bond. It is properly secured. It is normally issued by state government or central government or financial institutions. Bond. Zero coupon bond. It is very important from interview point of view. What is zero coupon bond? Anybody in the class? Anybody in the class? Zero coupon bond means what? 2 minutes time handed to you for recalling the point from your memory. You study this portion under investment management paper or international finance paper or international business. No idea. No idea. Zero coupon bond. No, that is not the answer. If you say there is no interest payable to dividend holders, it is called zero coupon. That is not the answer. No, fundamentally wrong. Any idea? First bench, third box, first one, third. No, not you. Next. Yes. You are sleeping. Please listen. What is zero bond? Your friend will help you to give the answer. Yes. Zero coupon bond. Yes. Change it. Yes. Your answer is correct. It's a fixed income security that pays, yes, interest on maturity instead of periodically during the life of the bond. Yes. So your answer is, if debenture interest will pay the amount, should pay the only at the end of the repayment period, not regularly. So your answer is correct or wrong? 100% correct. Please listen. It's a fixed income security that pays interest on maturity instead of periodically during the life of the bond. Okay. Anything else? You want to ask any question? No. Good. Switch over to next point. Tax-free bond. What is tax? Anybody in the class? Please stand up. Side row, first bench, second boy. I think you study income tax. Yes. What is tax? Tax means levy on income. Yes, correct. Levy on income. Imposed by whom? Imposed by central government. On whom? On assessee. Who is an assessee? Taxpayer. When a taxpayer is liable to pay tax, if the income exceeds the limit. If your annual income is more than the limit, you have to pay tax. It is called income tax. Income tax is an example for direct tax. Yes. So what is the slab? If anyone earns more than 2,50,000, he is liable to pay tax. What is the rate of tax? 3. No. 4. No. 5. Yes. The slab is there. Can you recall the slab? Can you recall? No. I will help you. Don't worry. Okay. First point. Up to 2,50,000 nil, yes. Second, 2 lakh to 5 lakh, 5%, yes. 5 lakh to 10 lakh, 20%, yes. Above 10 lakh, 30%. In addition, part says, what the percentage says? 3%, yes. Then, if any person earns more than 10 lakh net income, he is liable to pay surcharge. Surcharge means tax on tax. Okay. Anything else? Clear? Yes. Tax-free bond means if any person purchased that bond and earned any income that is fully exempted from tax, no tax should be payable. It is known as tax-free bond. Can you follow? No. Okay. I will explain you. Bonds are two types. Bonds and tax-free bonds. Bonds normally, if you earn any income on bond, it is called interest. If the interest rate is small, you have to pay tax to the government. If it's exemption from tax, no tax should be payable on bond. It is called tax-free bond. Clear? Yes, thank you. Next, so they are debt securities whose interest income is totally exempt from, in certain cases, the amount invested in this bond may also be exempted from wealth tax. What is wealth tax? Anybody in the class? Okay. Your good name please? Yes. Tax on wealth. You study income tax. Yes. So wealth tax means tax on wealth. When you are liable to pay wealth tax, what is the rate of tax? No idea? What is the net wealth? 25 lakh. Please increase. 30. Yes, that is the answer. If any person's net wealth is more than 30 lakh, he has to pay tax to central government at the rate of 1%, exactly 1%. 1%. What are the items exempted from this wealth tax? Agricultural land, yes. Commercial buildings, yes. Car, used for personal purposes, yes. Furniture, fixtures, fittings, used for personal purposes, yes. Whether gold is exempted? No. Gold is tax, yes. Gold come under wealth. Silver? No. Precious metals? Yes. So there are some items which are exempted from wealth tax and others are included. If you count, if you total it, if it exceeds 30 lakh, you have to pay tax. What the percentage? 1%. Next, junk bonds. Junk bonds means junk. These are high yield bonds. High yield bond means you will get interest based on growth rate. When the growth rate is high, you will get dividend more. When the growth rate is less, you will get less dividend. So just like a gambling, it's called speculative grade. Speculative means based on uncertainty. If there is a growth, you will get dividend, you have to pay interest more. If it is less, then automatically you can collect less interest. It's called junk bond, Junk. Okay, good. Next, Trustee Bills. These are short-term financial instruments issued by the government to enable people to invest surplus funds while avoiding default and risk. So, the government issued some financial instruments. They are known as Trustee Bills, short-term bills, short-term period for a period of 90 days or 100 days. Commercial paper, just like short-term security issued by the company to raise funds for their shorter requirements. No further explanation needed. Certificate of deposit, same. Is a negotiable instrument. Yes. Issued by financial institutions and the commercial banks acknowledging the receipt of deposit. It is called CD, commercial deposit, issued by financial institutions, banks, or any other institutions doing banking business. Floating rate bonds, that is, their interest is not fixed, interest is not constant, they are subject to change. So while issuing these kinds of bonds, it's a contract between the company and the person saying that you will get interest at the prevailing rate in the market. If the market rate increases, automatically you will get more dividend, more interest. If market rate goes down, you will get less interest. It is called floating rate bonds. Indexed bonds. It is indexed bond means it is a benchmark to an index or some other standard. Suppose you purchase a bond from the market. At the time, index value is say 120. At 120 index point level, you purchase 10,000 in the year 2018. At present, the index turned to be 200. What amount will you get? That's the question. So your answer is 10,000 by 120 into 200. 10,000, that is amount into current year base index divided by base year price index. Such bonds are commonly known as indexed bonds. Yes, equity linked. These are structured financial product that offers part of the upside potential return from owning certain equity stock but limits no nominal losses if held under maturity. Depository receipts. All these are financial instruments. These are negotiable instruments. What do you mean negotiable instruments? Anyone in the class? Anyone? BCom students? Instruments, yes, instruments which can be, yes, transferred from one person to another, yes, through endorsement and delivery. There are some instruments which can be transferred from one person to another for some value through endorsement delivery. It's known as negotiable instrument. Or there are three instruments which are recognized as negotiable instruments under the Act. Can you quote the name? Yes. Checks, yes. Bills of exchange, yes. Promissory notes. All these are fully negotiable in character. Negotiable means transfer from one person to another. Okay. So, So your in this module 2 is over. In this module 2 you study different financial instruments. Then next one is what are the different types of financial services under module 2. Please listen. There are different financial services, that is financial services, different financial services, that is leasing. Leasing means a financial lease means a financing capital equipments. It gives implies to the investment company and facilitate a flow of charge into real investments. Second, factoring. It is a financial services designed to manage the receivables, improve the seller's cash flow and cover risk. Yes. Third, bill discounting. You already know, is the practice of lending against commercial bills of a trader. Okay, very important. Next point, it may ask one mark in the examination point of view. Securitization, very important. It's a process of pooling and repackaging of homogeneous illiquid financial assets into marketable securities that can be sold to investors. Securitization means nothing but pooling and repackaging of illiquid instruments into market instruments. Pooling and repackaging of illiquid, not liquidity in character. If you want to convert into cash, you have to incur loss. So illiquid assets into liquid assets through conversion. It is called securitization. Next, venture capital. Initial capital required by a firm or organization which wants to promote its business. It deals with form of equity financing designed especially for funding, high risk and return, credit rating. It indicates an opinion on the future ability of the issuer to make timely payments of principal and interest of fixed income security. Merchant banking, offering specialized services like issue management, credit syndication. What is credit syndication? Any idea? Loan syndication. Suppose your company wants to get say 1 crore rupees. A particular company is unable to provide you, some financial institutions unable to provide you. Say they join together, one or two friends join together and contribute their own funds and hands over this fund to you for doing some business. It's called loan syndication. Next, credit card. You know credit card, it entitles the holder of revolving line of credit determined by the user's income. A credit card allows the card holder to pay the purchasers made for over a period. All these are known as types of financial services. Okay, second module over. Good morning to everybody. Today we shall discuss about merchant banking. That is covered under module 3. So what is merchant banking? What are the concept of merchant banking? State the roles of merchant banking. What are the functions of merchant banking, etc. If anybody asks you what are merchant banks? Merchant banks are neither merchants nor bankers. Can you follow? Merchant banks are neither merchants nor bankers. In Indian context, they are non-fund based, non-banking service organization. Non-fund based, non-banking service organization. So, merchant banks are neither merchants nor bankers. In the Indian context, they are non-fund based, non-banking service organization. What is banking? You know definition of banking: accepting for the purpose of lending or investment of money from the public, repayable on demand. Bank Regulation Act defines banking as accepting for money for the purpose of lending or investment from the public, repayable on demand. It includes three functions, accepting of deposit, mobilization of funds, lending the money in the form of loans and advances. If there is any surplus funds in their hands, that is to be invested outside securities. Section 6 of the Banking Regulation Act defines permissible business of banks, which include merchant banking activities also. So, Section 6 of the Banking Regulation Act includes merchant banks also. Okay. Then concept of merchant banks. Merchant bankers do not offer usual banking services to the public. They are not engaged in usual banking services. This bank separate the activities that facilitate trade and commerce. So, merchant banks do not offer usual banking facilities or services to the public. These banks specialize in activities that facilitate trade and commerce. SEBI Regulation Act and Rules 1992 defines what is merchant bank or who is a merchant banker. Any person who is engaged in the business of issue management, either by making arrangements regarding selling, buying or subscribing to securities as manager, consultant, advisor or rendering corporate advisory services in relation to such issue management. Please recall, SEBI Regulation Act, Central Security Exchange Board of India define merchant bankers. As per the rule, it defines any person who is engaged in the business of issue management, either by making arrangements regarding selling, buying or subscribing to securities as manager, consultant, advisor or rendering corporate advice services in relation to such issue management. Then next one, the activities of the merchant banker also cover project counseling, yes, pre-investment activities, feasibility studies, project reports, design capital structure, issue management and underwriting, loan syndication and mobilization of funds, foreign currency finance and advising service for managers, amalgamation, takeover, venture capital. These are the points which will cover under merchant banking. Please note it. The service of the merchant bank or the functions of merchant bank, it includes cover project counseling, yes, pre-investment activities, yes, feasibility studies, project reports, design capital structure, issue management, underwriting, loan syndication, and mobilization of funds, foreign currency, yes, foreign currency, then finance, advice services for mergers, amalgamation, takeover, and venture capital. All these points are included under the concept of what? Concept of merchant bankers. Okay, then merchant banking service providers, who are the key person playing the role under merchant bankers. The Banking Commission Act, that is known as BCA, introduced in the year 1972 in favor of setting a separate institute for merchant banking to render specialized services. As per the recommendation of Banking Commission, it was, as per the Act, it advised to set up a newly set up management for handling merchant bankers. However, merchant banking divisions and subsidiaries started by foreign banks, commercial banks, financial institutions, and private companies. So, there are 4 types of service providers. First one is called foreign banks. Second one is called Indian bank. Third one is called financial institutions. Last one is called private merchant bankers. These 4 plays a key role under where? Under merchant banking system. Remember, so we can study merchant service providers. Merchant banks, first one, foreign banks. Foreign banks means Greenlace Bank Merchant Bank Division was first to introduce merchant banking service in 1967. Greenlace Merchant Banking was set up in the year 1967, which turned to be the first bank rendering merchant bank services, Greenlace Bank. The second bank to start merchant banking activities in 1970. After 2 years or 3 years, then merchant banking branches are separately opened, along with Chartered Bank and Hong Kong Bank were also offering merchant bank services. So from 1960 to 70, there are 3 types of banks, 3 banks, foreign banks, which provide services to the community. They are Greenlace Bank, yes, in the year 1967. Then next one is called Chartered Bank, yes. Third one is called Hong Kong Bank. The three banks tend to be the bank which provide merchant services, or they are known as merchant bankers. In India, Indian banks, State Bank of India is the first bank to take up merchant banking activities. SBI Capital Market Limited Company was established. So, commercial bank, the first bank was promoted by SBI, which provides SBI Capital Market. Private sector bank all set up their merchant banking business. So, in actually Indian merchant banking then come to existence in the year 1978 after 8 years. Financial institutions also promotes merchant bankers. That is, separate divisions were started. Then Industrial Finance Corporation of India has its own merchant banking system. Last one, private merchant bankers. Number of private merchant bankers promoted the business of merchant banking from 1990 onwards. They are known as Carvey Investor Services Limited, for Moragan Stanley Limited, DSP Merit Lynch Limited, etc. So, service providers can be classified into four. First one is foreign banks, second one is Indian bank, third one is financial institutions, fourth one is private merchant bankers. Can you follow? So, a merchant bank means nothing but non-fund based, non-banking business activities which is promoted for the purpose of doing business. Okay, then functions of these banks. We can put into the functions through nutshell. Project advisory service, the first function. Second function is corporate advisory services. Third one is credit syndication. Fourth one is financial structuring. Fifth one is issue management. Next one is underwriting agreement. Last one is project management. So, more than 7 functions. So, what is merchant bank? What are its functions? Functions may be put into 7 categories or 7 steps. Project advice services. You want to promote a business, you prepare a project report, then what kind of information is needed for its promotion? That advice part is given by the merchant bankers. Corporate advisory services, that is, in order to do the normal day functions, you want some clarification. So, that clarification is given by merchant bankers. Then, credit syndication, finance structuring, issue management, underwriting, and portfolio management. These are 7 functions of what? Merchant banking system. Next one is need and importance, role of merchant banks. Role of merchant banks. What is the importance of merchant bank? First one is mobilization of funds, scattered savings from the public. Scattered savings from the public. So, merchant banks can also play a high significant role in mobilization of funds, savers to investable channels, assuming promising returns on investment. It collects small funds from the public by assuring a fixed returns on their investment. It can thus help in meeting widening demand for investable funds for community activity. So, first one is mobilization of funds from the public by promising high returns for their investment under less risk. Second function is called promotional functions. Promotional functions. The role of merchant bankers become very dynamic in the wake of diverse nature. Merchant banking services is the dynamism lies from promptly attending the corporation problems, assisting ways and means. So, if any company was put into trouble, the merchant banking system identify the reasons for their problems and put some remedies how the problem can be solved. So, they act as a guide. Next one is innovations. Innovations means how it can be developed. What is strategy adopted by the bank, by the company for promoting its business through innovations, new innovations. Next one is financial services. Financial services means all type of services in connected with finance. They provide funds, they act as advisor, they connect the link between the company and outside world. Market makers. So they play the role of an agent for selling securities issued by the institutions. Next one, consultancy services. They act as a guide or analyst and hands over some services to the community. So these are the main functions of what? Functions of merchant bank. Mobilization of funds, first one. Second one is promotional function. Third one is innovation. Fourth one is financial services. Fifth one is market making. Next one is consultancy services. So the question is asked for examination point of view, what is merchant banking, what are its functions. So please write the functions one by one. Mobilization of funds, yes. Promotional function, second, yes. Innovation, third. Financial services, 4. Market makers, 5. Consultancy services, 6. There are 6 points. Then functions of merchant bank. Functions of merchant can be studied under more than 15 heads. Corporate counseling, first point. Second point is project counseling. Corporate counseling, project counseling. What kind of advice needed for the project? How it can be implemented? What is the time needed for the project? How much amount can be expended for it? Whether there is a deviation, how the deviation can be curtailed or solved, etc. Next one, credit syndication or loan syndication. That is, if any company wants to get finance, suppose some individual cannot provide such funds. So, number of companies join together and collect the funds and hands over this fund to somebody else. It is called loan syndication. Issue management. While issuing shares and debentures, they are controlled by such merchant bankers. Underwriting of public issue. Underwriting means somebody plays the role of agent for connecting the link between the company and the public. They will get a commission. That commission is known as underwriting commission. Then bankers issue. The merchant bankers act as the bankers issue, especially when the bank is a broker to the company. It has given underwriting commitments. It is an acting managers in the issue, to the issue. Next one, portfolio management. Portfolio management, and if the company plays an important role. How much fund can be invested in each securities? What is the return? What is the risk, etc. Advice services regarding to merger and takeover. Merger and takeover means 2 or more companies join together and form a new company is called merger. If one company absorbs the business of another company, it is called takeover. So in the case of merger and acquisition or takeover, it plays an important role. Next one, venture capital financing. For the promotion of any industry, seed capital is needed. The seed capital finance is provided by the merchant bankers. Leasing. If the person is unable to pay the entire amount, then what will happen? The assets were given by the bankers on the base security, then only possession is transferred, not the ownership. The ownership is the hands of the original company. Next one, services to non-residents, NRI people, no explanation needed, accept a credit bill and bill discounting. Suppose a trade transaction takes place, suppose the person is not unable to pay the entire money in one lump sum, so he asks the other person to execute a document. That document writing is known as bills of exchange. If the original owner wants to get back the money, he has the right to surrender the bill to the bank and ask the bank to pay the amount in advance. It is called bill discounting. Arrangements offshore finance. Offshore finance means outside the countries, foreign countries. Then management of fixed deposit companies, the relief to sick industries. So these are the functions of what? 15 points connected with what? 15 points connected with role of for the functions of merchant banking. Then very important, categories of merchant banks. How merchant banks are classified. Based on licensing and categorization prescribed by the SEBI, merchant bankers are classified in 3 groups. Category 1, they are permitted to perform issue management functions as well as lead managers, co-managers, portfolio managers, underwriters, consultants, and advisors to capital issues. The bank must have minimum net worth of 5 crores. So, merchant banks play the role in 4 categories. First category means they act as advisor, brokers, dealers, portfolio managers, issue managers, lead managers, etc. The intention behind it is what? To do the work very smoothly to the community. Category 2. But in the case of category 1, the minimum capital required is 5 crores. Category 2, they are permitted to take the functions of co-managers, assistant, co-managers, underwriters, consultant, and advice to capital issues. They can also known as portfolio managers. They have minimum net worth of 50 lakh. That is, in order to help the main person, his agent or his warden or somebody else play the role of what? Play the role of merchant banking system. Category 3, they undertake the functions of underwriters, consultants, advisory to capital issues. Such a company should have the minimum worth net worth rupees 20 lakh. So the structure is based on what is the capital contribution. If it exceeds 5 crores, that is falls under category 1. If the company falls under category 2, it has a minimum of 50 lakh. Third category is 20 lakh and fourth category is bill 20 lakh. So category 1, category 2, category 3 and category 4 represents what? Represents the categories of merchant banks in India. Then that is how we can classify merchant banking position. So we can classify into 2, pre-issue management and post-issue management. Pre-issue management means before issue. They are known as lead managers, first point. Then appointed agencies, second point. Underwriting of shares, securities, etc., third point. Appointment of brokers, fourth point. Assessing capabilities of other intermediaries, fifth point. Appointment of bankers as their agents. Next, appointment of registrars, selecting printers, processing formalities, completing stock exchange activities, advising publicity, overall supervision. So there are 12 points which will cover pre-issue management activities. Post-management activities include, that is 5 points, analysis or collection of data, secondary or primary. Second one, processing of data after analyzing, collecting, processing. Third one, allotment of shares and debentures, practical. Then issue of refund orders, allotment letters. Last one, listing of securities. Listing means registering a company name through the court of law. It is called listing. So these are the main parts of what? Merchant bankers and issue management. Issue management. So that topic is over. Good morning to everybody. Today we shall discuss about what? Credit rating. What is credit rating? What are the principles of credit rating? What is the importance of credit rating? Etc. Then what are symbols of credit rating? Why credit rating is needed? Anybody in the class? Have you heard about this one? Credit rating? No. Okay. Credit rating is a process. So it's a process by which risk associated with financial instruments is evaluated. Risk is connected with investment. Low risk, low investment. Medium risk, medium investment. High risk, high investment. So what is the whether the risk is connected with the investment or not, to what extent it is connected. So, a study about, it is a process by which risk associated with financial instruments evaluated. You know different kinds of financial statements, instrument studied by you under module 1, etc. However, it does not indicate market related risk or predict price or yield of financial investment. So, three things are very important. It does not tell us what is the market, what is the risk connected with the market. Okay. Second, predict prices. What is the expected price? Third one, yield of financial investment. What is the return on investment? It is an expert opinion, very important. Credit rating is an expert opinion on the relative ability and willingness of an issuer to make timely payments on specific debt instrument. It is an expert opinion. Suppose you are the investor, you want to invest money in some securities, bonds, issues, etc. You approach somebody else. Based on portfolio management, how much amount is invested in each portfolio? Whether it will give a result or not. Is there a risk in the investment or not? To what extent it is connected? Expert opinion. So, credit rating is nothing but an expert opinion done by a third party for the benefit of the investor under portfolio management. It shows the chances of timely payment of interest and principal by a borrower. Very important. Suppose the borrower is sound or not. You invest the amount in a company, whether the company can repay the debt to you after a certain period. So it puts some way. It is a qualitative as well as quantitative approach by an expert. He verifies all things, whether the investment is correct or not, whether the company is able to discharge its liabilities within the time limit or not. It provides a relative ranking and credit quality of debt instruments. Relative ranking means based on which is more liquid, which is less liquid, then what? On credit quality of the debt instrument. That is whether the investor can recover the amount from the company or not. So this is the basic principles of credit rating. If anybody asks you what is credit rating, please explain. It is an expert opinion about that instrument. That means a ranking of the ranking of the investment based on qualities, whether it is safe or not. It is given by somebody else. They are known as credit rating agencies. Credit rating agencies. The ratings are usually expressed in alphabetical or symbols. They enable the investor to differentiate between debt instruments on the basis of the credit quality. So, just like suppose you are applying for examination, A plus is above 90%, A is 80 to 89, then B plus 70 to 80 in that manner. The quality of the credit instrument is given by the company on the basis of alphabetical numbers AAA, AA, A, triple B, double B, B, C and D. So there are 8 type of classification. So you identified the investment ranks. In which category it falls. So credit rating is a symbolic indicator of what? Symbolic indicator of the current opinion of the relative capability of the issuer to service its debt obligation of timely fashion. That is, he is an advisor. He gives some advice based on the quality of the credit instrument, whether they are good or bad. On that basis, you take decisions. So, in brief, credit rating is an assessment of the capacity of an issue debt security by an independent agency to pay interest and repay the principal as per the terms of issue of debt instruments. So third party's opinion about the quality of the instruments. Over. Credit rating is nothing but a certificate given by an independent person about the quality of the credit instrument issued by some other companies. You are the investor, you want to subscribe shares. At that time, you approach somebody else, ask whether my decision is correct or not. He tests the investment in a manner and hands over the report to you. Based on this report, you can take your own decision. Then next one is definition of what? Credit rating. Credit rating is a CRISIL. CRISIL means that is a private limited company which is engaged in rating of credits, quality of the instrument. It is called Credit Rating and Information Services Limited. It is called CRISIL. CRISIL means Credit Rating and Information Services of India. Then another is there, ICRA. That is, ICRA stands for Investment Information Credit Rating Agency of India. Another private institutions which were engaged in credit rating. So, ICRA, CRISIL and CARE, Credit Analysis and Research Limited. So these are the institutions which are working in a private sector responsible for credit rating in India. There is no government sector or public sector. That is, the entire credit rating system is followed by these 3 companies, CRISIL, ICRA and CARE. So as per the CRISIL, it defines credit rating as an unbiased and independent opinion as to issuer's capacity to meet its financial obligations. It does not constitute to recommendation to buy or sell or hold a particular security. A third party opinion, whether you can accept it or not, they are not bothered. But if you ask the quality of the instrument, they will give their report. It is definition of what? Independent party's opinion about that instrument. Over. Next, ICRA. ICRA says ratings are opinion on the relative capability of timely servicing corporate debt and obligation. Please note, credit ratings are opinion on the relative capability of timely servicing corporate debt and obligations. So, these definitions are recommended definitions. Okay. Good morning to everybody. Today we shall discuss about leasing. Have you heard about leasing? No. Okay. So today we shall discuss about leasing. In this chapter you are required to study what is leasing, what are types of leasing, objectives of leasing, salient features of leasing, constraints of leasing, what is the tax implication on leasing, etc. What is the importance of studying this leasing? Suppose you want to promote a business. Okay. You want to be a manufacturer of products. You need what? Machinery for converting the raw material into finished product. So if you want to start this business, you need machinery. So if you want to purchase this machinery, the value of machinery tend to be very high. Due to some financial difficulty or financial problems, you are not in a position to purchase a machinery, say worth 3 lakh or 4 lakh or 5 lakh immediately, and you are not in a position to install it. So without human labor you can't do any work. Same manner, without machine labor, that is machine work is needed. If you want to manufacture the same product through human labors, it tend to be high. Cost is too high. In order to avoid this, you want to do all these operations through machine. So you want to install machinery. If it is available in India, that is good. Suppose you want to import the machinery from a foreign country, the cost of the machinery tend to be too high. You are not in a position to put your investment in machinery. So under these circumstances, a company or a person is ready to hire the machinery to you. Then only possession is transferred by the person to you. Ownership is within the hands of the original person. So for hands over this machine to you, he may charge some rent. So the agreement between these two persons is known as what? Leasing. So leasing is nothing but transfer of possession of assets from one person to another through an agreement. The agreement is known as lease agreement, and the person who transfers this asset, who acquires this asset, is not lessor, and the person the person who provides you is known as lessee. So the agreement is known as lease agreement. In simple means, leasing refers to a contract under which owner of the asset allows another person or party to use the asset in return for some rent. The owner of the asset is called the lessor, and the person who uses it, or the person who is the user or who is the beneficiary, is known as lessee. Can you follow? Yes or no? Say yes or no. No. Yes, thank you. That means leasing refers to a contract. It's a contract. Okay, it's a contract enforceable by law. Yes. Then between two parties, One is the owner and other is the user. Can you follow? Say yes or no. Second bench, fourth girl, please stand up. Can you follow? Yes. What is leasing? Leasing refers to a contract, yes, between two persons, yes, that is the owner and the user. The subject matter is transfer of assets. While transferring, only possession of the asset is transferred by the owner to the user for some consideration. This consideration is called rent, lease rent. Okay. So, it is a contract between the user and the owner for transferring of possession from the owner to the user for some consideration. The consideration is known as rent or lease rent, and only possession is transferred, not the ownership. Ownership rests in the hands of the original person. The agreement is known as lease agreement. That is, the assets could be any product, say example, plant and machinery, furniture, fixtures, etc. That means it is connected with tangible assets only, not intangible. It is connected with movable or immovable. So mainly leasing is connected with company form of organization because they were engaged in manufacturing operation. They want to install machinery for doing what? Manufacturing work. Okay. Clear? Concept clear? Any doubt? No. Good. Then definition. Number of definitions given by different persons. First definition, please note, the International Accounting Standard Committee, International Accounting Standard Committee, IASC, International Accounting Standard Committee defined what? An agreement whereby a lessor conveys the lessee in return for rent the right to use the asset for an agreed period of time. Can you follow? No. It is an agreement. It is an agreement whereby the lessor conveys the lessee, the owner conveys the user in return for rent, the consideration which may pass us from the lessee to the lessor is in the form of rent. For what purpose? The right to use the asset for an agreed period of time. So agreement, two parties, subject matter is asset, movable or immovable, yes. Consideration is form of rent, yes. Period is certain. If these 5 points are included, that is known as lease. This definition given by IASC, International Accounting Standard Committee. Another definition is given by European Lease Association. It gives a contract between lessor and lessee for the hire of its specific assets selected from a manufacturer or vendor of such asset by the lessee. The lessee can have possession and use the asset on payment of specified rental over a period. Only possession is transferred, not ownership. Ownership is transferred only after the period. Okay? Over. So, leasing means a contract or a contract agreement between the user and the lessor, user and the owner for transferring of assets from one person to another for some rent. Then what are the special features? Any idea? What are the special features? No idea. Yes. First one is the essential prerequisite of leasing is existence of the asset. That is very important. At the time of transferring, at the time of entering into contract, the existence of asset is must. So, existence of the asset, first feature. Second, a lease is not sale. A lease is not a sale. You know, at the time of sale, the ownership is passed to the buyer. When the asset is transferred, ownership is passed to the buyer. But under lease, only possession is transferred. So, lease and sales may be different. In what respect? First case, possession is transferred. In the case of lease, second case what? Ownership is transferred. So, existence of the asset, it is not a sale. The economic life of the asset should be redeliverable or at the expiry of the lease. Redeliverable means what? You acquire the asset through an agreement, say for some period, say 5 years or 6 years. At the end of the period, the user is liable to return the asset to the owner. That is called redeliverable. Please catch the point. First bench, second boy. Yes, please stand up. Yes, the question towards you is, what are the features of lease? Yes. Redeliverable, yes. It is not a sale, yes. Existence of the asset is required. Over. Fourth point, the asset is movable. That means it can be relocated. It must be movable. Next, the economic identity of the asset is to be maintained. Next, the transfer of asset take place. Next, lease is not merely a creation of rights to rentals. It is an investment in the value of an asset. These are the special features of lease. Please recall the points from your memory. Last bench, second boy, please stand up. Can you recall the points? Yes. Okay. Please give the points. Yes. First one, existence of the asset. Good. It is not a sale. Good. It is movable in nature. Yes. Redeliverable. Yes. The economic life of the asset should be less than the period of the lease. Yes. The economic identity of the asset is to be maintained. Yes. The transfer of the asset take place. Yes. Lease is not merely a creation of right to rentals. It is an investment in the value of asset. How many points? Please count 7 points. So what is lease? What are the special features of lease? Can you follow? Anybody have any doubt? Please stand up. Please stand up. Nobody have no doubt. Thank you. Shall we continue? Yes. Next one, leasing process. Leasing process. Leasing process, it may pass through different stages. It's called process. On that is input and output, just like first process is lease selection. Lease selection means a lessor has to select the type of asset to be taken for lease. It has to select the lessor as well. Usually, lessor select a lease on the basis of the lease payment, reputation of lessor, terms of guarantee and warranties, installation service charges, and the period of time taken to lessor to finalize the deal. It is called lease selection. So, lease selection includes the following points, that is lease payments, guarantee given, terms of guarantee, installation, service charges who will bear, etc. Second one, lessor's appraisal. Appraisal means lessor appraises the leasing proposals. To take decision on lease proposal, the lessor has to carefully study the number of commercial documents called attendance lease. Third process, lessor's approval. So, first one selection, second one appraisal, third one approval. It is approved by both persons, lessor and lessee. Next one, acceptance of the offer letter. That is, the agreement should be signed by both the parties. Last one, come to an agreement is registered. So, selection, yes. Appraisal, yes. Approval, yes. Acceptance of the offer, yes. Last one, agreement, signing of agreement. All these are known as what? Leasing process. Then the constituents of leasing industry, who are the person plays an important role under leasing agreement. First one, private sector lessors. There are number of private sector company engaged in the lease. Private sector lessors. Second, specified leasing houses. Third, leasing and hire purchase finance companies. Fourth, the captive leasing companies. Next, vendor leasing. So, 5 types, please recall: private sector lessors, specified leasing companies, leasing on hire purchase of finance companies, subsidiaries of manufacturing groups of companies, the captive leasing companies, and vendor leasing. Public sector type: financial institutions, yes. Banks and subsidiaries of the banks, other public sector organizations. All these are what? The private sector lessors. These are lessors, major part of lessors. That means private sector, government sector, specialized leasing companies, leasing financial corporations, captive leasing companies, etc. Private sector lessors, public sector. Lessors in the public sector companies are leasing divisions of financial institutions, subsidiaries of nationalized and commercial banks and other public sector operations. Then it includes financial institutions, banks and subsidiaries, other public sector. Lessees, same manner, public sector undertakings, government departments, private sector companies and individuals. All these are the players of lease agreement. Advantages of leasing. So, discuss the advantages from the point of view of the owner and the user. Owner lessor, then the user lessee. Owner's point of view, safe financing. That means a lessor is the owner of the asset. If a lessee fails to pay the rent as per the lease agreement, a lessor can repossess the asset. Can you follow? Yes or no? Clarification needed. Yes. We study the merits and demerits of lease agreement from the point of view of user and from the point of view of the owner. First we look at the point of view of the owner. Okay. Shall I continue? Yes. First one, safe financing. That means the user is liable to pay the rent. If he fails, the assets can be repossessed by the owner from the user as per the agreement. He is not liable to repay any rent already collected. So, safe financing. Better profitability. That means the income earned through leasing is greater than indirectly lending finance. Suppose if you provide any finance to the institutions, normally the charges, you charge interest at the rate of 10 or 12%. But if you fix a rent for the asset, that is more higher than the interest rate. That means it will increase the profitability of a business unit. Next, benefit of tax treatment. A lessor can enjoy the relief by way of depreciation. Leasing assets with high depreciation considerably reduces tax liability. Lessors in high bracket. Appropriate modification of rental value helps to provide tax benefit. That means beneficial tax treatment means the depreciation charged on asset is allowed, which will reduce your profit. That means you are exempted, that is, such portion is deducted from your net income. So, in the case of lease rent, tax is deducted. It is tend to be a saving of a person. So, tax treatment. Financial leverage. Financial leverage means what? That means financial leverage means the weighing of the debt and equity. Whether debt is more than equity or vice versa. If the debt amount is more than equity, it is called high leverage. That is favorable to the concern. That means outsiders' funds were utilized by the company for achieving its goals and objectives. That is, if you borrow funds, that is utilized in your business, which will give some profit, the share of profit is given form of interest. So, that is less risk. Reverse, if the ownership is more than the asset, sometimes ownership is, that means beneficial tax treatment here means, suppose the interest rate is more than the rental value, then there is no benefit to you. So, tax liability, financial leverage, weighing the position, Weighing the position means whether debt is higher than equity. If debt is higher than equity, that means high leverage. Debt is less than equity, low leverage. Debt is equal to equity, it is called no leverage. So, no leverage, debt is equal to equity. High leverage, debt is more than equity. Low leverage, debt is less than equity. So, this includes what? This includes which fund is used for running the business, whether borrowed fund or own fund. Play the game with a third party's money. Don't play the game with your own money. Chances for incurring loss is there. So that concept is used here, financial leverage. Then resist the low phase of business cycle. Even during the period of depression, a lessee can acquire machinery low cost. Lessee does not require heavy capital to start a business. This particular aspect helps the leasing industry related to how phase the business cycle. There are 4 wheels of business cycle: boom, recession, depression, and recovery. So, it will resist low physical business cycle. All these points are connected with advantages of lease agreement from the point of view of the lessor, that is owner. Please catch the point. Saves financing, better profitability, beneficial tax treatment, financial leverage, resist the low phase of business cycle. All these points are connected with merits of leasing from the point of view of the user. Then merits from the point of view of the user. First one owner, second one user. Less finance is needed. That means instead of putting your investment for purchase of machinery, you have to pay the rent only. So, lesser finance. Cash flow benefits. Cash flow benefits means that is lease rent payment should be deducted from tax. Then promoters control. The promoters control over the company is diluted if the required finance is raised through equity or debentures instead of leasing. Avoidances of restrictive conditionality. In case of institutional finance, usually the providing agents has to be given a place or the board or other facilities like conversion of loan into equity. All these are merits of what? Merits of lease agreement from the point of the lessee. Please recall: less finance, cash flow benefits, off-balance sheet financing, promoters control, avoidance of restrictive conditionality. All these are the points connected with merits of what? Lease agreement. Then disadvantages of lease. Costly premature termination. If the lessee wants to terminate the contract before the expressway period, the lease agreement, it entails higher payout obligation. Suppose the user wants to cancel the contract with the owner, he has to pay some compensation to the original owner. That means, so that is called costly premature termination. And constraints on the leased assets. Through the agreement, the lessee transfers the possession of the asset to the user. Without the permission of the user, he can't transfer the asset to his sublease. For transferring the asset sublease, prior sanction should be obtained from the original owner. Constrain the use of leased asset. Okay. Next, lessee is not the owner. he cannot pledge the asset with any third party. All these are what? All these are drawbacks of lease agreement. So what are the points? Please note, your point is costly premature termination, yes. Constraints on the use of leased assets, yes. Lessee is not the owner of the asset. All these are demerits of leasing. Then types of lease. Types of lease. Types of lease may be financial lease and operating lease. Finance lease and operating lease. Finance lease is a method of equipment financing. Finance lease is a method of equipment lease financing. It is a not cancelable lease contract for long term or medium term. It cannot be cancelled. A lessor extends credit to lessee and transfers the responsibilities of ownership such as maintenance, insurance, taxes to the lessee for a period of time equal to the economic life of the asset. The lease rental are fixed in such a way that to recover the marginal cost of financing. So, finance lease means a method of equipment financing. It is a not cancelable contract for a long term or medium term. Lessor extends the credit to the lessee and transfers the responsibility of ownership such as maintenance, insurance and taxes, etc. Features of operating lease. A lessee selects the equipment and lessor. Lessee has the right to select the lessor and asset. A lessor may recommend alternate equipment, but the final decision is the lessee. So, financial lease, he can choose any asset, but with the permission of the lessor. A lease uses the agreement for specific purpose of business, not for every business. Third one, equipment is purchased by the lessor. The equipment is purchased by the owner of the asset. Then a lessor keeps the title of equipment throughout the life period. Next, finance lease is not cancelable. It cannot be cancelled. Then loss on account of obsolescence, equipment is borne by assessee and it is responsible for repairs, maintenance, etc. Then operating lease. It is a simple agreement between the owner and the user which provides for the exclusive use of the equipment by a lessee for a monthly fee. That is monthly rent. Whenever he wants to purchase the asset, then he can have the lessee has the right to recover the asset from the original vendor and pay the amount. Operating lease generally remains an effect of short-term period. Finance lease long-term, this is short-term. The main difference is that possession is transferred, ownership possession is transferred. There, for a long-term purposes, here short operating lease only for short-term period, then it is generally remain the effect for a short-term and medium period. Agreements are usually for a certain number of months or year with an option to extend. The number of months or period upon mutual agreement. Advantages of operating lease. Lease has operational advantages as it imposes the profitability of the business. That means profits are generated by the use of the equipment without acquiring ownership. The ownership is in the hands of the owner, but the benefit is enjoyed by the lessee. Second one, it enabled the lessee to diversify his business to avoid risk. Third one, it is generally responsible for the insurance, operations and maintenance, repairs, operating crew, etc. Then equipment is based as per the user's need for short-term period. Next, it enhances purchasing power of the lease. So, exemption point of view, very important. State, differentiate the finance lease and operating lease. Here, we classify or we segregate or we give some points of distinction between these two items based on number of lessee, amortization of cost of lease asset, responsibility, revocation of lease, period of lease. So, we classify, we put difference under 6 heads. Number of lease. Finance lease, single case only. Finance lease is single case. Whereas operating lease is several cases, several lessees. Under financial lease, there is only one lessee, user. But under operating lease, number of subagents are there. Then amortization of cost of lease asset. Full cost is recovered from lessee. But here full cost is recovered from many lessees because number of operations are more. Next point, responsibility. Lessor has the main responsibility. Here lessee has the responsibility under operating lease. So number of lease, single and multiple, amortization, full cost, then here full cost recovered from number of lessees, responsibility, lessor has the main responsibility, here lessee has the main responsibility in the case of operating lease, revocation of lease, non-cancelable contract, it is called financial lease, cancelable contract is known as operating lease. Period of lease, long-term period, here short-term period. Here short-term period. Then next one, income tax consideration. Lessor as a finance device has tax implication for tax benefits, both the lessor and lessee. In fact, tax concession is allowed for both. Income tax consideration, that is allowed expenses. That expenses are allowed for both person. Tax concessions are there. Then tax liability of rentals. Rental incomes are considered for income from other sources or profits and gains of business or profession. So, if the rental income is considered as an income, following expenses are deductible: depreciation, repairs and maintenance, amortization a part of assets, interest on borrowed capital, bad debts, all expenses incurred in furtherance trade or business, maintenance expenses, trade expenses, all these are deductible expenses. So, module then last point, reasons for growth of Indian leasing, that is rapid industrial growth is one of the reason. Next, availability of funds. Second point, less legal requirements, tax concessions. These are the 4 reasons for the growth of leasing industry in India. Rapid industrial growth, first point. Availability of funds, second point. Less legal requirements, third point. Tax laws. Then what are the problems of leasing industry at present? Because they should follow number of rules and regulations. Second one, service tax is imposed on lease rental. Then disparity between assets and liability period, because the period is either for short term or long term. Then competition from other companies. All these are four problems. Place number of laws to be followed. Service tax is impossible. Disparity between assets, liability periods, competition. All these four or five points are connected with problems of leasing industry. So that topic is over under module 4. Last module we have to study last module tomorrow itself. Good morning to everybody. Today we shall discuss about insurance. So the learning objectives of insurance means, first of all, you study principles of insurance. Second, different kinds of insurance services. Third one, providers of insurance services. Fourth one, regulations related to insurance services. So, learning objectives 4. Then, insurance industry is an integral part of the financial services, and profound changes have been taken place in this sector in India. Can you follow? It is an integral part of financial services which promotes what? Which promotes changes have been taken place in the sector of India. This is because a well developed and properly evolved insurance sector is needed for economic development. So, insurance helps to promote economic development. The first point. Can you follow? It is an industry, integral part of financial services, yes, which promotes economic development of India. It is not only provides long-term funds, needed for the infrastructural development, but also strengthen the risk-taking ability of individuals and institutions. Risk-taking ability of individual and institution. Can you follow? It's a integral part of financial services. It promotes economic development of India. Not only provides long-term funds for infrastructure facilities, but also strengthen the individuals and institution. Then the concept of insurance. Insurance is a form of risk management. It is an integral part of financial services. Yes, it is also a part of risk management. Risk management primarily used to hedge against risk of contingent loss. It is defined as transfer of risk of a potential loss. Transferred from one entity to another in exchange of the premium. So, insurance is connected with risk management. Okay. Here, risk is transferred from one entity to other individuals or institutions in exchange for a premium. Insurance applies situation where loss may or may not occur. That is contingent or not contingent. It cannot apply situation where loss is expected to happen. It is not applicable to certainty position. So it is related to contingent event, not real event. While insurance company sells that insurance services, an entity seeking to transfer the risk of an individual or corporation or association. Here it includes the following points. It includes the following key elements. Parties to insurance. There are 3 parties to insurance: insurer, insured, and beneficiary. Actually, insurer, insured, and beneficiary. Parties to insurance. Second, premium. The amount charged for insurance coverage. It is called premium. The amount charged for insurance coverage is called premium. Period of coverage. What is the duration of a particular loss is covered? Duration period. So parties, premium, period. So 3 P's over. Amount of coverage. What is the amount of insurance coverage? Sometimes it may be huge or it may be sometimes small. Exclusions, that is the events not covered. So five key elements: parties, premium, policy, amount, exclusions, that is the events not covered. Thus, insured person is an indemnified against the event of loss covered in the policy. That is, insured is the person who insure his life or other subject matter with the insurance company for a premium. The insured is an indemnified person. Indemnifier means the company in which the insured took policy. Insurance company is also known as insurer. The person who insured is known as indemnified. Third one, what is the premium? What is the amount of coverage? What is the amount for insurance charges? It is called premium. He pays the premium either weekly, either monthly, or quarterly, or half yearly, or yearly. Here, the insurance company is liable to pay the amount whenever the event occurs. In the case of life insurance company, the insured will get either after the maturity of the period or the death. In the case of death, his nominee or dependent will get the benefit. But in the case of general insurance, when the event actually occurs, he will get the benefit. So, insurance contract, life insurance contract is called assured and assurance. Assured, assurer, company, assured the person who took life policy, and contract, assurance contract, because it is definite in nature. But in the case of general insurance, the person will get the amount only from the company whenever the actual event happens. You pay the premium annually, then when an event occur in a particular year, you get back the amount, otherwise not. Just like it's considered as an expenses. Then, principles of insurance. Principles of insurance. Insurance is based on two principles. It is called principles of probability and principles of cooperation. These are the main two principles which are followed in the case of insurance. Principles of probability, that means the degree of loss depends upon number of factors or various factors. That means the degree of loss depends upon number of factors. All the affecting factors are analyzed and the probability of loss is calculated. So, number of factors which will affect the insurance coverage. Each factor is to be analyzed individually. It is based on probability. Probability means chances of occurring the event. Then the law of large numbers is applied in the principles of probability. It is assumed that past event will occur the same pattern. This is based on this insurance principle of insurance is based. The premium is fixed on the basis of past events, present condition and future prospectus. The premium amount is fixed on the basis of past events, yes, present conditions, yes, future prospects. So, principles of probability mean chances of occurring the event. The event is uncertain. Number of factors which will affect the business. Each factor should be analyzed. Chances for occurring the event is analyzed clearly. Then it is assumed that past events will occur in the same pattern. That is, the events occurs are in similar manner. The premium is fixed based on the past events, yes, present condition and future prospect. It is called principles of probability. Can you follow? Yes or not? If you can follow, say yes. If you can't follow, say no. So, insurance is a contract between two parties, yes, for sharing the risk of loss. Three parties were involved in insurance. Who are they? Yes, insured, insurer and the beneficiary. The payment towards insurance is known as premium. It is based on full amount. Amount of coverage is very clear. Then exclusions from the insurance are clearly noted. It is based on two principles of probability. Next is called principles of cooperation. In insurance, the loss is shared by a group of persons who are willing to cooperate in the case of reinsurance. If the subject matter is reinsured with the other companies, then they share the loss. Principles of cooperation is must. The insurer collect the shares of the insured person in advance and accumulate its fund. A member paid this fund at the time of occurrence of the insured risk. The present insured pay the premium to join another insurance schemes. Thus, the insured cooperates to share the loss of an individual by advance payments of premium. It is called reinsurance. So, two principles of cooperation and principles of probability. Features of insurable risk. A number of homogeneous exposure units. First one, Second one is loss is definite. First one is a large number of homogeneous exposure units. Second one, loss is definite. Third one is loss is incidental to the business or life. Next one is premium should be affordable. Next one, loss is calculable, which can be calculated. Next one, risk exposure is limited. So 7 features. First feature, a large number of homogeneous exposure units. First point. Point number 2, loss is definite. Third one, loss is accidental. Next one, premium should be affordable. Next one, loss is to calculate. Last one, risk exposure is limited. So there are 6 features which will govern the insurance. Next one, advantages of insurance. What are the advantages of insurance business? First point, it involves proper planning and administration to reduce the loss due to uncertainties. It will reduce the loss in connection with uncertainties. So first point is, please recall, it involves proper planning and administration to reduce the loss due to uncertainties. Second one, it ensures certainty. That means certainty of payments. When the event occurs, the benefit will get, the insured person will get the benefit. Next one, all the persons who are exposed to share the risk of loss. If the business is reinsured, the company is liable to repay the amount to the policy holder. Then the insurer employs the funds in productive channels. The fund is utilized only for productive purposes. Last one, it improves the efficiency of the insured person because it liberates him from the worry of the loss. So these are the 5 advantages. Please recall, it involves proper planning and administration to reduce the risk of loss. Second, it ensures certainty of payment. Third, all the persons who are exposed to share the risk of loss. The insurer employs funds of productive channels. Last point, it improves the efficiency of the insured persons. It liberates him from the worry of loss. These are the main advantages. So, come to the point. What is insurance? Yes. What is the concept of insurance? Yes. What are the elements of insurance? Yes. What are the principles of insurance? Yes. What are the features of insurance? Yes. What are the merits of insurance? Over. Next, categories of insurance. 3 broad categories of insurance. First one is life insurance. Life is the subject matter of the insurance of an individual or a person. Next one is general insurance, other than life business, accident, marine, earthquake, war, uncertain, then what? Then gambling, burglary, etc. Next one, reinsurer, that is, it is insurer's insurance. The insurer want to reduce the risk, so he took a policy from another company and reinsured the business of insured. It is called reinsurance. So categories of insurance may be 3 types. Life insurance, life is subject matter. General insurance, other than the life subject matter. Reinsurers, that is insurance of insurer's business. It is called reinsurance. Life insurance. Life is the subject matter of the insurance. The policy holder is entitled to get back the money from the company after the maturity of the insurance. If he died before maturity, his legal representative will get the benefit after producing certain documents. Any extra points you want to need? Life insurance is a contract between insured, it is called assured and assurer. Assured and assurer. Assurer is the company, life insurance company, and assured is the policy holder. Subject matter of the insurance is life. The policy holder will get back the amount when the policy is matured or when he died, which come earlier. Then here very important, it is a long-term contract signed by the insured and insurer. He will get back the amount only. Which one comes first? Either maturity of the period or death of the person. Then it includes, life insurance includes payment of premium. Payment of premium is definite. Either payment may be in the form of weekly, in the form of cash, either weekly, either monthly, or quarterly, or half yearly, or yearly, by the policy holder to the company. Next, bonus. A share of profit is given by the company to the policy holders based on bonus. Life insurance business is a long-term contract. So, the profit of the company is arrived through a statement. It is called valuation balance sheet. The valuation balance sheet is prepared by the accessories, that is the officers of the insurance company. Once in 3 years, the bonus will issued. That means the valuer compare the surplus and net liability to policy holders. The remaining amount is known as profit. The 95% of the profit is distributed as dividend to shareholders or bonus shareholders, and remaining 5% to shareholders. The statement is prepared. It is called valuation balance sheet. Then benefits. The insurance provides several benefits. They are survival benefits, accidental benefits, disablement benefits. Survival, accidental, and disabled benefits. Then life insurance policy. There are number of policies under life insurance. First one is called endowment policy. Second one is called whole life policy. Third one is called term policy. Fourth one is called money back policy. Fifth one is called joint life policy. Sixth one is called children's education policy or children insurance policy. Next one is called group policy. So there are more than 8 or 9 life insurance policies. So the person who took policy is known as policy holder, okay, or the insured. Different types of policies are in front of him. He can opt which one he likes. That means endowment policy, whole life policy, term life policy, money back policy, joint policy, children's insurance policy, and group policy. These are the 7 points, which includes what? That is elements, different types of policies. What are the matters stated in life insurance policy? Following are the matters. Name of the plan governing policy, its terms and conditions. Name of the plan governing the policy, its terms and conditions. Second, whether it is participating in the profits or not. Third one, basis of participation in shares, cash bonus, deferred bonus, simple bonus, etc. Benefits payable, who is the actual beneficiary? Next one, date of commencement of risk, when it started. Age at entry, whether the same had been admitted or not. Then any special clauses, conditions, the address of the treasurer to which communication in respect of policy. All these points are to be noted in connection with amount stated in life policy. Next one, life insurance providers. Who are the life insurance providers? Under public sector, a company, it is called life insurance business, Life Insurance Corporation of India. Public sector. Private sector, there are 12 companies which are working under private sector. Some of the examples are Allianz Bajaj Life Company, HDFC Standard Life, ING Vaishya Life Insurance Company, Max New York Life Insurance Company, SBI Life Insurance Company, Tata AIG Life Insurance Company, etc. Then factors to be considered while framing the policy: one's own income level, tax planning, number of dependents, the wealth, income and expenses. Next, the significant forcible expenses. Next, the inheritance and lifestyle provided for them. Please note, income level, yes. Tax planning, yes. Number of participants, yes. Dependents, yes. The wealth, income and return, expense level. The significance, foreseeable expenses. Then the inheritance and the life cycle, proposed business. General insurance. Subject matter other than life is called general insurance. It may connected with accident, fire, earthquake, marine, burglary, etc. Then it is for a short period of time. Every year it is duty of the person to pay the premium. Suppose the particular year the event is not happen, then he will not get any amount from the insurance company. Whenever the events happen, he will get back the amount. So every year the duty of the policy holder to pay the premium amount. General insurance products, generally fire insurance, yes. Marine insurance, yes. Motor insurance, health insurance, miscellaneous insurance. These are the general insurance products. And then matters to be stated in the general insurance policy: name of the policy holder, subject matter of the claim, whether accident, fire or earthquake. Then what is the time period granted? What is the premium amount payable by the assurer to assured? Next one, then any deductions applicable, policies, terms and conditions, maturity of the policy, etc. Reinsurance means the subject matter of the insurance is reinsured by a company to another company. It is called reinsurance. For reinsurance, they should pay the premium amount to another company. At the same time, they will get commission for it. It is called commission on reinsurance ceded. So reinsurance share the risk of loss. It is to be shared by a company. Then last point. Insurance Regulatory Development Authority, IRDA, is the controlling act which controls the affairs of insurance business in India, protect the interest of insurance policyholders and regulates the insurance industry. IRDA is an act which controls insurance business in India. So the topic is over. Thank you.